Okay, students, so let's start our today's live session. In today's live session, we are going to practice a long question on single entity financial statement. The approach for the preparation of single entity financial statement will be same just like the previous session. First, we have to read the requirement. Then we have to prepare the structure according to the trial balance provided by examiner. And then according to the relevant notes, we have to prepare the financial statement for the single entity, right? So let's start from the requirement first. Two requirements. Requirement A, prepare the statement of profit or loss and other comprehensive income for Atlas for the year ended 31st March 2023. We have to prepare the statement of profit or loss and other comprehensive income for Atlas company. The year end for the Atlas is 31st March 2023. And the marks for this part is 9 marks, right? Remember the year end is 31st March 2023. So the year start will be 1st April 20x2. If the year end is 31st March 2023, then the year start will be 1st April 20x2. And I'm telling you again and again in every practice session that the dates are really important in the financial reporting paper, right? The dates are really important in the financial reporting paper because we have to recognize income and expenses for the year, right? So must remember the year end, the year start date. So the year start is 1st April 20x2 and the year end is 31st March 20x3. Okay, requirement B, prepare the statement of financial position of Atlas at 31st March 20x3. And the marks for this requirement is 11. So 9 plus 11 is equal to 20 mark. Notes to the financial statement and a statement of changes in equity are not required. So only two requirements. One, we have to prepare the statement of profit or loss and other comprehensive income. And then we have to prepare the statement of financial position. The year end is 31st March 20x3. No note is provided by the examiner that all the working to the nearest $1,000. But if you look into the trial balance, all the working here are to the nearest $1,000, right? So first, we have to tell our examiner that all working are to nearest $1,000, right? As we already read the requirement, now we have to prepare the structure. So part A, the requirement is to prepare the statement of profit or loss for Atlas and other comprehensive income, profit or loss and other comprehensive income for Atlas company for the year ended 31st March 20x3. Let me double check. Statement of profit or loss and other comprehensive income for Atlas for the year ended 31st March 20x3, right? Now let's move towards the trial balance. The following trial balance relates to the Atlas at 31st March 20x3. Okay. Okay, so equity share, retained earning, land and building, plant and equipment, accumulated depreciation, inventory, receivable, bank, deferred tax, and payable. These are all the elements of statement of financial position, not to the statement of profit or loss. Elements of statement of profit or loss starts from here: revenue, cost of sale, distribution cost, administrative expense, bank interest, because interest is on the debit side of the trial balance, right? So it is expense, and then the income tax. Okay. So now let's prepare the structure. Revenue less cost of sales, gross profit less distribution cost less administrative expenses. A mandatory subtotal name is operating profit. Then we have to add investment income. And another subtotal name is profit before financing and income taxes. Okay. Then we have to deduct the finance cost. Then profit before tax. Okay, then we have to deduct the income tax expense. And at last we will get profit for the year, right? Then other comprehensive income, and I will make the adjustment in other comprehensive income according to the relevant notes, right? So this is the structure for statement of profit or loss. And for other comprehensive income, I will have to make adjustment according to the relevant notes. I will leave some land for other comprehensive income. So this was all about statement of profit or loss and other comprehensive income, right? Structured for the Now, part B, statement of financial position of Atlas company. Look, yes, there is at 31st March 2023. It will start from assets, then non-current assets. Okay, so in non-current asset, we have property, plant, and equipment, right? Then current assets. Okay, so if you look into the trial balance in current assets, we have inventory, receivable, and what about bank? If you look, the balance of the bank is on the credit side, right? It is on the credit side. If you remember from your basic study, bank is an asset. Asset is debit by nature, right? Bank is an asset and asset is debit by nature. But if in the trial balance, the balance on the bank is shown on the credit side, it means that it is bank overdraft. It is bank overdraft and it will be shown under the heading of current liability, right? If this balance was on the debit side here, and it is on the debit side, so it's the asset for the Atlas company, current asset. But if the balance of the bank is shown on the credit side, so it means that it is a bank overdraft and it will be shown under the heading of current liability, right? So only two types of current asset, one is inventory and the other one is trade receivable, nothing else. Inventory, trade receivables, leave some lines, and then equity. Okay, so for equity, we have ordinary share capital, retained earning, share capital, retained earnings, right? And we have to prepare the statement of profit or loss, another comprehensive income. So it's virtually certain that there will be adjustment for the revaluation surplus as well. But I have to make adjustment according to the relevant notes. I will leave some line for that as well, right? Then liabilities, and liabilities, non-current liabilities, right? And in non-current liability, we have the deferred tax only. No bank loan is here, right? Only the deferred tax. Okay, then current liabilities, right? So for the current liabilities, we have bank and trade payable, bank, trade payable, and also the tax payable, right? So it is the structure for statement of financial position, which we have prepared according to the trial balance provided by examiner, a complete structure. Okay, so now let's start from the relevant notes. Okay, the following notes are relevant. Note number 1, revenue includes. So the first note is all about the revenue, right? So revenue includes, the figure for the revenue is 550,000. This includes the sale of 10 million of maturing inventory. Before we start the explanation on maturing inventory, let me make the working for the revenue and the balance as per trial balance. It is 550,000, right? 550,000. Now, this 550,000 include 10 million sales of maturing inventory, because the examiner is saying that the revenue includes, means that 550,000 includes 10 million on the sale of maturing inventory. Did you remember what is maturing inventory? In IFRS 15, revenue from contract with customer, I already explained that what is a maturing inventory, right? So can you tell me what is a maturing inventory? Anyone? Maturing inventory is that inventory which has a long shelf life. Maturing inventory is that inventory which has a long shelf life, right? And normally company use maturing inventory in a repro agreement, repurchase agreement. What is repurchase agreement? I have to sell something and I have the option to repurchase it from you. So this agreement is known as repurchase agreement. So in repurchase agreement, no control of inventory is transferred, no performance obligation is satisfied. If no performance obligation is satisfied, so the company cannot recognize the revenue. Any amount received will be treated as a loan, and they will charge interest cost or interest expense in the statement of profit or loss. Let me repeat it once again. Maturing inventory is that inventory which has a long shelf life. Maturing inventory is that inventory which has a long shelf life. And normally company use maturing inventory in a repurchase agreement. Repurchase agreement where no control of inventory is transferred, no performance obligation is satisfied. So therefore the company cannot recognize revenue on the sale of maturing inventory, right? They will treat the amount received as a loan and they will charge interest cost in the statement of profit or loss. So now the Atlas company include the sale of 10 million of maturing inventory in the revenue, which is made to exceed on 1st October 2002. On 1st October 2002, mid of the year, right? As the year end is 31st March, I already told you. So the year start will be 1st April 2002, and the transaction incurred on 1st October 2002 after the 6 months, right? After the 6 months. The cost of the goods at the date of sale was 7 million, and Atlas has an option to repurchase these goods at any time within 3 years of the sale at a price of 10 million plus accrued interest from the date of sale at 10% per annum. I already told you that maturing inventory is normally used in repurchase agreement, right? At the year end, the option has not been exercised, but it is highly likely that it will be before the date it lapses, right? So let's make adjustment. Start from the revenue figure. Revenue include the sale of 10 million of maturing inventory, which is wrong. It means that the revenue is overstated because it is a maturing inventory. Maturing inventory is used in repurchase agreement. In repurchase agreement, no control is transferred, no performance obligation is satisfied. So therefore, a company cannot recognize the revenue on the sale of maturing inventory, or you may say on repurchase agreement, right? So because of this, the revenue is overstated. We have to reduce the revenue. I would say sale of maturing inventory is equal to minus 10. We are doing all of our working to the nearest $1,000. So minus 10,000, right? Sale of maturing inventory. Now we are done with the first line. Now second line. The cost of the goods at the date of sale was 7 million. The cost of goods, the cost of inventory which is sold is 7 million. It was sold on 10 million. So we have done the adjustment for the revenue. Now we have to do the adjustment for the inventory as well. Now, whenever the company recognized the revenue on the sale of inventory, they removed it from their inventory, right? Whenever a company sold some goods, they removed it from their inventory. They remove it from the inventory, right? You already know about this. So if the Atlas company recognized the revenue on a sale of maturing inventory, so it is virtually certain that they remove these goods from the inventory as well, right? They remove this inventory, these goods from the inventory as well, which is also wrong, because if no control is transferred, no performance obligation is satisfied. So therefore, a company cannot derecognize their goods from the inventory. It must be included in the inventory of the atlas. They must not remove it. But if they recognize the revenue, so it's virtually certain that they remove these goods, which has a cost of $7 million, it is removed from the closing inventory. If it is removed from closing inventory, one effect will go into the cost of sale, right? Balance is for the trial balance. For the cost of sale, the balance on the trial balance given is 411,500. Now, cost of sale value is calculated as opening inventory, right? Then we have to include purchases, and then we have to deduct the closing inventory, right? So a figure is calculated named as cost of sale, right? How cost of sale is calculated? Opening inventory plus purchases minus closing inventory. Opening inventory increase the cost of sale, purchases increase the cost of sale, while closing inventory decrease the cost of sale, right? Closing inventory decrease the cost of sale. Now, if you look into line number 2, as I already explained that the cost of good which is sold is $7 million, right? It is a sale of maturing inventory which is used in a repurchase agreement. No control is transferred, no performance obligation is satisfied, revenue should not be recognized, and we already did adjustment for that. Now, if Atlas recognize the revenue, it's virtually certain that they remove these goods from the inventory as well. So if they remove these goods from the inventory, which has a 7 million, it means that the closing inventory is understated, right? If they remove the $7 million from the goods from the inventory, so it means that the closing inventory is overstated, because according to repurchase agreement, if no revenue is recognized, you must not remove the goods from your inventory. If no revenue is recognized, you must not remove the goods from inventory. It should be included in your closing inventory. Now, if the Atlas recognizes the revenue, it is virtually certain that it has been removed from the closing inventory as well. So if it is removed from the closing inventory, it means that your closing inventory is understated, because it must not, because it is a repurchase agreement. So if it is removed, so the closing inventory is understated. If the closing inventory is understated, it means that the cost of sale is overstated. Because if you reduce the closing inventory, your cost of sale will increase. If you reduce the closing inventory, your cost of sale will increase. Now the closing inventory is understated, so the cost of sale is overstated. Now what we have to do? We have to decrease the cost of sale. So is equal to minus 7 million. So 7 multiplied by 1,000, right? Closing inventory is understated. It means the cost of sale is overstated. Now reduce the cost of sale and make the adjustment of this in the inventory as well. So it's equal to the closing inventory is 4,700 and add 7,000 here as well, because the closing inventory is understated. Here, now, it is a repurchase agreement. So any amount received will be treated as a loan, as a liability, as a financial liability. And the amount of the loan is 10 million, right? So 10 million means 10,000. 10 multiplied by 1,000. It is 10,000. Because the amount received is 10 million. Now, if liability is recognized, so it means that we have to calculate the interest cost on that liability as well. So make another adjustment right here. Working finance cost. The balance as per the trial balance, which is 700. Now, interest cost is equal to, it is 10 million, so means 10,000 multiplied by the rate of interest is 10%, right? And multiply by 6 by 12, because if you remember, I already told you the transaction date is 1st October 2002, while the year start is 1st April 2002. So the transaction is 6 months after the year starts, 6 months after the year starts, so it is mid of the year. So we have to calculate the expenses and income just for the 6 months, right? Multiply 6 by 12. So interest expense debit. Now, if the interest expense is debited, the other double entry credit entry will be liability credit, right? So interest expense debit and liability credit. So this was all about relevant note number 1. Okay. Now note number 2. There is non-current assets. On 1st October 2082, the same date, 1st October 2082, after the 6 months of year start, Atlas terminated the production of one of its product line. From this date, the plant used to manufacture the product has been actively marketed at an advertised price of $4.2 million, which is considered realistic. So which IFRS is going to cover note number 2, the first paragraph of note number 2, which IFRS? Terminated one of its product. Now they want to sell a non-current asset. Remember IFRS 5, non-current asset held for sale. As the note number 2, the relevant notes is all about the non-current assets. So on 1st October 2002, they want to terminate production of one of its product line. They want to, yeah, right? So from that date, the plant used to manufacture the product has been actively marketed, actively looking for a buyer, not passively. Condition met at an advertised price of $4.2 million, which is considered realistic, which is a fair value, right? So second condition met, so it means that it will be classified as an held for sale. And it will be the date of classification is 1st October 2082, mid of the year, right? So let's make working for this as well. Working plants and equipment. So I will make the 2 column, right? I can do it combinedly as well, but I will make the 2 column to avoid the confusion. What is for the other plant? Other plant means if we remove that plant which is classified as a held for sale, right? You can calculate the depreciation expense for the first 6 months, then remove the plant which is classified as a held for sale, and then calculate the depreciation for the rest of these as well. But it will be too much confusing, right? So make the 2 column, one is for the other plant, the one is for the plant which is classified as a held for sale, because the plant which is classified as a held for sale. So up to the date of classification, we will charge the depreciation expense. Once it is classified, then we will stop the depreciation for held for sale, right? So first for the other plants, and we have to do the calculation now for the 1st April 20x2 at the start of the year. So at the start of the year, the cost of the plant is already given in the trial balance. It is 94,500. And we have to deduct the accumulated depreciation, which is 24,500. So the carrying amount at the start of the year is 70,000. Now, if you look the depreciation method, plant and equipment is depreciated at 20% per annum using the reducing balance. Plant and equipment is depreciated using the reducing balance method, and time apportion is appropriate, right? So now we have to remove that plant which is classified as an held for sale. The cost of that plant is, it included in the trial balance at a cost of 9 million with accumulated depreciation at the start of the year is 5 million. So it's equal to 9 minus 5 multiplied by 1,000. So it is 4,000. Now the carrying amount for the rest of the plant is 66,000, right? So the plant which is classified as an held for sale, the carrying amount at the start of the year for that is 4 million. Clear? Now we have to charge the depreciation expense. So the depreciation expense is 20% per annum reducing balance method. So carrying value multiplied by the rate. It is the depreciation expense, and carrying amount at the end of the year will be 52,800. It is carrying amount at 31st March 20x3. Right, carrying amount at 31st March 20x3 at the year end. It is 52,800. Clear? Okay. Now for the plant held for sale, here we have to charge the depreciation expense up to the date of classification. So it's equal to 4,000 multiplied by 20%. And the date of classification is 1st October 20x2. The date of classification is 1st October 20x2. So we have to charge the depreciation expense for the 6 months. The carrying amount at the date of classification is 3,600. Now we have to classify as an held for sale. It will be lower off because we already applied the applicable accounting standard. Now it will be lower off carrying amount, and one is fair value less cost to sell. So the carrying amount is this, while the cost fair value less cost to sell is 4.2 million. Which one is the lower one? It is the carrying amount, right? 3,600. So in statement of financial position, it will be shown separately. Held for sale is equal to, give the reference, enter. Clear? So it was all about the notes related to the plants. Okay. Now let's move towards another para. On 1st April 20x2. Now it is 1st April 20x2, means at the start of the year. The director of Atlas decided that the financial statement would show an improved position if the land and building were revalued to market value. At that date, an independent valuer valued the land at 12 million and the building at 35 million, and these valuations were accepted by the directors. So they were revalued at the start of the year, because examiner is talking about 1st April 2002, and it is the start of the year where they want to apply the revaluation model on the land and building because it will show an improved position. So the value for the land is 12 million and the fair value for the building is 35 million at the start of the year, and these values were accepted by the directors. The remaining life of the building at that date was 14 years. Atlas does not make an annual transfer to retain earning for excess depreciation, and we have to ignore deferred tax on revaluation surplus as well. So it's quite simple because we will not make an annual transfer for excess depreciation as well, and we will not calculate the deferred tax on revaluation as well because the examiner told you. Now, make a separate working for land and building. So here we have land, we have the building. The cost of the land is land and building at a cost, land 10 million, the total is 60,000. So 10 million means 10 multiplied by 1,000, while the total cost for the land and building is 60,000. So if 10,000 is for the land, then the remaining is for the building, right? Now accumulated depreciation at the start of the year, because we have to revalue the land and building. And so for that, we have to find the carried value, right? For the building. So accumulated depreciation at the start of the year for the building is 20,000. $10,000 It is 30,000. It is the carrying amount at the start of the year. Now, the revalued amount is, for the land, it is 12 million, and for the building, it is 35 million. So 12 million, and for the building, it is 35 million. So the revaluation surplus will be is equal to 12 minus 10, and for the building, it will be 35 minus 30, and the total revaluation surplus will be 7,000. So it will be recorded over here. Revaluation surplus on land and building, which is 7,000. Clear? And it will be recognized in the equity as well. The revaluation surplus is equal to, give the reference, enter. So it is recognized in other comprehensive income as well, and this equity as well, right? So this is the good point. When you already prepare the structure, make the adjustment accordingly. A complete revaluation surplus at the start of the year, 7,000. 2,000 for the land, 5,000 for the building. Now just look to this requirement, then we will calculate the depreciation expense as well. Should we proceed? Okay. Now let's calculate the depreciation expense. So after revaluing the asset, what will be the formula for depreciation? So it's quite simple. Is equal to revalued amount divided by remaining useful life, and the remaining useful life at that date was 14 years. So it is 2,500, and the carrying amount at the year end will be 32,500, 12,000 for the building. So the total carrying amount for the land and building is 44,500. You can show them separately here as well, right? Make a column for the land and building, and then for the plant and equipment as well. And you can show them aggregately as well, just like the total for the land and building plus the carrying amount of the other plant as well, right? Because it was classified as a held for sale, and add with this, so you will get property, plant, and equipment of 97,300. It is the total carrying value of land and building plus the carrying amount of the other plant as well. So it is equal to 97,300. Okay. All depreciation is charged to cost of sale, but not has yet been charged on any non-current asset for the year ended this. So let's charge the depreciation to the cost of sale. So here, depreciation expense on plant and equipment is equal to, it is this for the other plant, and don't forget the 6-month depreciation expense, which is classified as a held for sale, right? And on the building, the depreciation expense is 2,500, right? So for the plant and equipment, the depreciation expense on other plant, and 6-month depreciation expense for that plant, which is classified as an held for sale, and the rest on the building as well. So we have charged that is to cost of sales. Okay. The second last note. At 31st March 2023, a provision is required for director bonuses equal to 1% of the revenue for the year. So what is the total revenue? It is this 540,000, right? So a provision is required. So provision will be charged to cost to administrative expenses. So let's make a working for administrative expense. The balance is for the trial balance, which is how much for the administrative expense? It is 30,900, right? 3900. Now provision will be 1% of the revenue. So 540,000 is the revenue multiplied by 1%, right? So provision expense debit and the provision liability will be credited. Provision for the director bonus, you can write for the director bonus as well if you want. Provision for director bonuses. Prepare the structure and make the adjustment accordingly. So it will be quite simple for you. 5,400 and the entry. Provision for director bonuses. Here, the last note. Atlas estimated the income tax provision of 27.2 million is required for the year ended 31st March 2023. So let's make another working, or let me make it right here at the end. So working income tax. What is the structure for the income tax? Current year estimate, adjustment for over and under provision, and then movements in deferred tax. So the current year estimate is 27.2 million. And it will be recognized in statement of financial position as well. So the tax payable is 27,200, right? Now, and that date, the liability to deferred tax is 9.4 million. So the closing balance on the deferred tax is deferred tax. Opening balance, closing balance, and it is 9.4 million. So the closing value is recognized as a deferred tax liability as well. And the statement of financial position, I already explained it. And the movements will go into statement of profit or loss or other comprehensive income accordingly, right? The movements on the deferred tax should be taken to profit or loss. As examiner already told you, it should be taken to profit or loss. The balance on the current tax and the trial balance represent the under and over provision of the tax liability for the year ended this. So any balance here for the current tax will represent under and over provision. So 1,200 is on the credit side. As it is over provision or under provision. What do you think? 1,200 is on the credit side. Over provision or under provision? When it is on the debit side, it is under provision. When it is on the credit side, so it is over provision. And over provision decrease the income tax expense. So it is 1,200. Right? Now, movement in deferred tax. So the opening balance is already given here. Deferred tax, note number 4, which is 6,200. So it is increase in deferred tax. How much is the increase? It is 9,400 minus 6,200. The increase in deferred tax is 3,200, and it will increase your income tax expense. Now total it. It is 29,200. Charge it right for here. 29,200, right? And make and negative sign at the start. Just check. It is the working for the income tax. Clear to everyone? As the end of the relevant notes. Now start the closing. Is equal to my 40,000 is the revenue, while I will calculate the cost of sale over here. And what will be the cost of sale is equal to sum and this. Distribution cost, no working for the distribution cost. So it will be same just like the trial balance 21,500 for admin. Right? And investment income, no working, so 0. Profit before financing income taxes will be same just like the operating profit. The finance cost, right? Now the profit for the year is 31,200, and now total comprehensive income will be profit plus revaluation gain, 38,200. First check the statement of profit or loss, then we will proceed toward the statement of financial position as well. It's the complete picture of statement of profit or loss and other comprehensive income. Okay. For the trade receivable, no working. So it will be same just like the trial balance 42,200. Right? So the current asset other than held for sale is this. And if I include, then the current asset is this, the held for sale, right? Share capital, no working. So it will be same just like the trial balance, 50,000. For the retained earning at the start of the year is given 11,200. We have to add the profit for the year, 31,200, and you will get the closing retained earning. For the bank, it is 6,800, no other adjustment. And for the trade payable, no adjustment, so it is 35,100. Now we have to show the examiner whether our assets is equal to capital plus liabilities. So the assets mean non-current assets plus the current assets. It is the equity. This is non-current liability. It is the current liability, while the total liability is non-current plus current, right? So capital plus liability. So both are matched. It means that we have done our statement of financial position of profit or loss correctly, and you will get 20 marks, right, in your paper. So this was all about the Atlas company, financial position, and profit or loss.